EPK Capital presents Daily Brief for 13/02/2025. Hello everyone, welcome to EPK Capital's Daily Brief video. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So without further ado, Let's begin with a snapshot of the global markets, which experienced a turbulent end to last week and a cautious start to the new one. Global market snapshot. Global markets are currently being dictated by a sharp escalation in US-China trade tensions. United States, on Friday, Wall Street witnessed a significant sell-off. The Dow Jones Industrial Average tumbled 1.90%, closing at 45,479. The S&P 500 saw a steeper decline of 2.71% to end the day at 6,552. The tech-heavy Nasdaq composite was hit the hardest, plummeting 3.56% to 22,204. This marked the worst session for the S&P 500 since April. However, heading into the new week, there's a glimmer of hope. U.S. futures are pointing towards a rebound. S&P 500 futures were up approximately 1.6%. and Nasdaq 100 futures rallied over 2% in early Monday trading. European markets are showing resilience and are poised for a stronger open. Euro Stoxx 50 futures were up by about 0.3%. On Friday, the FTSE 100 in London fell by 81 points to close at 9,427, dragged down by the global risk-off sentiment. Asian markets had a rough start to the week, reacting to the sharp downturn on Wall Street. Hong Kong's Hang Seng Index slumped by a staggering 3.5%. The Shanghai Composite in mainland China dropped 1.3%. South Korea's Kospi declined by 1.7%, and Australia's S&P ASX 200 slid 0.9%. Markets in Tokyo were closed for a public holiday. The macro story: a sudden escalation in the US-China trade war. The primary catalyst for this widespread market volatility is the renewed and intensified trade dispute between the United States and China. Late last week, President Donald Trump made a surprise announcement threatening to impose a massive 100% tariff on Chinese goods, set to take effect on November 1st. This was in retaliation to Beijing's expanded curbs on its exports of critical rare earth materials. These materials are essential for a wide range of technologies, from smartphones to military hardware. This aggressive stance from the US sent shockwaves through the financial markets, which had been enjoying a period of relative calm. The sudden escalation has reignited fears of a full-blown trade war between the world's two largest economies, prompting a flight to safety and a sell-off in riskier assets. However, over the weekend and into early Monday, the rhetoric from the US administration appeared to soften. This toning down of the aggressive language has provided some relief to the markets, as evidenced by the rebound in US futures. This rapid back and forth in trade rhetoric underscores the current fragility of market sentiment. Investors are on high alert, and any new developments in this space will likely lead to significant price swings. Economic indicators and other macro news. Beyond the trade war headlines, here are some other key macroeconomic factors to consider. China's yuan. The Chinese yuan has shown some resilience. After weakening significantly on Friday following the tariff threats, it has recovered some of its losses. This was aided by a stronger than expected midpoint guidance rate from the People's Bank of China. The onshore yuan was trading around 7.95 per dollar in early Asian trade. US government shutdown. Adding to the uncertainty, the US government shutdown has entered its 10th day. This is starting to put pressure on federal workers and contractors and is another headwind for the US economy. The Bureau of Labor Statistics has announced a delay in the release of the September Consumer Price Index (CPI) data, now expected on October 24th due to the shutdown. U.S. consumer sentiment. The University of Michigan's preliminary consumer sentiment survey showed that consumers remain concerned about high prices and a weakening job market. They do not anticipate a significant improvement in these areas in the near future. However, one-year inflation expectations did edge down slightly to 4.6% from 4.7%. Commodities and bonds. In the commodities market, oil prices are recouping some of their recent losses. Brent crude was up around 1.52% to 63.68 a barrel, while WTI crude rose about 1.51% to 59.79 a barrel. Prices had fallen sharply on Friday due to concerns that a trade war would dampen global demand. Gold has been a major beneficiary of the recent risk aversion, with spot gold rising 1% to a new peak of around $4,056.62 an ounce. In the bond market, U.S. Treasury yields fell sharply on Friday as investors sought the safety of government debt. The 10-year Treasury yield dropped to 4.05%. It's important to note that the U.S. bond market is closed today, Monday, October 13th, for Columbus Day. Crypto Corner, a market in turmoil. The cryptocurrency market has not been immune to the recent turmoil. In fact, it has experienced one of its most volatile weekends in recent memory. Following the U.S. tariff announcement, the crypto market saw a massive wave of liquidations. On Saturday, Bitcoin plummeted 8.4% to around $104,782, leading to a wipeout of approximately $19 billion across the entire crypto market. According to some reports, over 1.6 million traders were liquidated in a 24-hour period. The price of Bitcoin has since seen some recovery and is currently trading around $114,761, down about 0.2% on the day. Other major cryptocurrencies also saw significant drops, with Ethereum falling to around $3,637 and XRP plummeting. This event has been described as the largest single-day liquidation in crypto history, highlighting the sector's vulnerability to geopolitical shocks. Despite the recent crash, some analysts remain bullish in the medium term, pointing to historical patterns of corrections followed by relief rallies in October, a month often referred to as Uptober by the crypto community. Looking ahead, a cautious outlook. As we move into the week, the market's direction will continue to be heavily influenced by the US-China trade narrative. Any further developments, whether positive or negative, will likely trigger significant market reactions. Investors will also be keeping a close eye on the ongoing US government shutdown and any signs of a resolution. The key takeaway for today is that we are in a period of heightened uncertainty. The market is reacting to headlines, and this is likely to continue in the short term. While the early signs on Monday are pointing towards a more stable start to the week, the situation remains fluid. For long-term investors, periods of high volatility can present opportunities to acquire assets at lower prices. However, it is crucial to remain disciplined and to conduct thorough research before making any investment decisions. That's all for your market update today. We'll be back tomorrow to break down another day of market action. Until then, trade smart and stay informed. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice.